Silver just crashed below $76 an ounce. And if you think this is just a normal pullback, you are about to make the most expensive mistake of 2026. Because what is happening in the silver market right now has not happened since the 2011 collapse. And the next 48 hours, the next 2 trading sessions, will determine whether this is the buying opportunity of the decade or the beginning of a brutal multi-month breakdown. Stay with me, because most channels won't tell you what I'm about to show you. Welcome back. If you're new here, this channel is dedicated to one thing, giving you the kind of macro financial analysis that institutional traders use without the jargon, without the spin, and without the agenda. Today we are breaking down the silver plunge in real time. We're going to look at exactly why silver dropped, the mechanics behind it. Then we'll examine what the central banks, the COMEX data, and the technical charts are all screaming right now. And finally, I'm going to walk you through 3 very specific scenarios for what happens next and what each one means for your wealth. Because here's the truth. Moments like this are rarely what they look like on the surface. Let's get into it. Let's be precise about this, because the mainstream financial media is already spinning a narrative, and that narrative is incomplete. Yes, silver dropped sharply. Yes, it broke below the $76 level that technical analysts had been watching as critical support. But the why matters enormously here. 3 forces converged at the exact same moment. First, a surprise shift in Fed language. The latest FOMC minutes, released just days ago, signaled that the Federal Reserve is in no rush to cut rates further. Real yields, that's the return on U.S. Treasuries adjusted for inflation, ticked back up. And here's something Wall Street analysts know but rarely explain clearly. Rising real yields are silver's kryptonite in the short term. They make holding a non-yielding asset like silver feel less attractive to institutional money. Second, a coordinated wave of COMEX futures liquidation. If you look at the Commitment of Traders report, the QOT data-managed money funds had been building an enormous net long position in silver futures over the past 4 months. That's a crowded trade. And when a crowded trade starts to move against the crowd, the exits get brutal, stop losses cascade, margin calls trigger more selling. It becomes a self-feeding spiral. That is exactly what we watched happen over the past 72 hours. Third dollar strength. The DXY index, the US dollar index, spiked as traders fled to safety after fresh geopolitical turbulence in the Middle East and new concerns about European sovereign debt. A stronger dollar mechanically pressures silver prices, since silver is globally priced in dollars. But here's what almost nobody is telling you right now. Each of these 3 triggers is temporary, and the deeper structural forces underneath silver have not changed at all. Now pay attention, because this changes everything. While traders are panicking over a short-term futures flush, the physical silver market is flashing completely different signals. The Silver Institute's latest supply-demand data confirms that the global silver market has been in a structural deficit for 3 consecutive years. 3 years running. Mine supply is not keeping up with demand, period. And where is that demand coming from? 2 places that are only going to grow. The first is industrial consumption, specifically the green energy transition. Every solar panel requires silver. Every electric vehicle contains silver contacts and circuitry. Every grid-scale battery system, every semiconductor. The International Energy Agency projects that solar capacity alone will triple by 2030. The silver required for that build-out is staggering, and it cannot be replaced by any other metal at industrial scale. The second demand driver is monetary, and this is where Europe comes in directly. The European Central Bank has been in an extraordinarily difficult position. Inflation in the Eurozone has proved stickier than the ECB's models predicted. The euro has weakened meaningfully against both the dollar and the Swiss franc. And European households, particularly in Germany, Austria, the Netherlands, and France, have a deep historical memory of currency debasement. They know what happens when central banks lose control of the inflation narrative. Physical silver coin and bar demand from European retail investors has surged significantly in 2025 and 2026. German and Austrian dealers are reporting wait times on certain silver products. That is not the behavior of a bear market. That is the behavior of people who are quietly, deliberately protecting their wealth before the window closes. This is what the big banks don't want you to focus on right now. While paper silver futures contracts is being sold aggressively, the physical silver situation on the COMEX itself is tightening. Watch the registered silver inventories. Registered silver is what's actually available for immediate delivery. That number has been declining for months. The ratio of open interest, that's the number of outstanding futures contracts, to registered physical silver has been climbing toward historically extreme levels. What does that mean in plain language? It means there are an enormous number of paper claims on silver relative to the physical metal sitting in COMEX vaults ready for delivery. If even a small percentage of those contract holders decide they want physical delivery instead of cash settlement, the squeeze potential is extraordinary. This dynamic played out in a smaller form in early 2021. We all remember what happened to silver then. The January 2021 short squeeze pushed silver from around $25 to nearly $30 in days, before the clearinghouses intervened by raising margin requirements. The setup today, in terms of the registered inventory to open interest ratio, is arguably more extreme than it was then. Is a squeeze guaranteed? No, nothing in markets is guaranteed. But the structural kindling is there. Let's talk about what the price chart is actually telling us. Silver has broken below $76, a level that had held as support through multiple tests over the past several months. When a support level breaks, it typically becomes resistance on the way back up. That's basic technical analysis. But here's where it gets interesting. $76 was not the only important level. Below it, the next major technical support zone sits in the $72 to $73 range. That zone coincides with a long-term Fibonacci retracement level from the entire 2024 to 2025 bull run. It also coincides with the 200-week moving average, one of the most powerful long-term trend indicators in the market. If silver finds support there and bounces, and the relative strength index, currently deep in oversold territory, suggests a bounce is statistically probable, you are looking at a potential double or triple bottom structure. That kind of base, built at a major support confluence, is historically the foundation of the most explosive bull runs. The upside targets on a confirmed reversal. Technical analysts are eyeing $88 as the first meaningful resistance, with the next major target around $96, and in a full breakout scenario, the $100 psychological barrier comes into play before end of year. On the downside, if $72 fails, if the market closes below that level on meaningful volume, the next support is significantly lower, around $64. That scenario would represent a deep correction and would delay the bull run thesis by 6 to 12 months. Let me give you the framework I'm using right now. Scenario 1. The bull case, probability 55%. Silver stabilizes in the $72-$76 zone over the next 48-72 hours. Volume dries up, which means the sellers are exhausted. Then a catalyst triggers a reversal. Weaker than expected U.S. economic data, a Fed official signals openness to rate cuts, or a fresh wave of geopolitical instability drives safe haven buying. Silver bounces hard, reclaims $76, then $80, then moves toward $88 by Q3 2026. This is the scenario where the bull run resumes and the people who bought the panic are vindicated. Scenario 2, the consolidation case, probability 30%. Silver grinds sideways in a wide range between $72 and $80 for the next 4 to 8 weeks. Neither bulls nor bears fully take control. This is actually a healthy scenario. It allows the market to digest the recent excess, rebuild a base, and set up for a more sustainable move higher later in the year. Frustrating for traders, opportunity for patient accumulators. Scenario 3, the bear extension, probability 15%. The $72 support fails. Selling accelerates. Silver drops toward $64 or $65. This would be painful for those who bought into the $80-$90 range expecting a smooth continuation. However, and this is critical even in this scenario, the long-term structural bull case for silver remains fully intact. A drop to $64 would simply represent a deeper correction before an even more powerful eventual recovery. History is full of those. Here's the hard truth that most YouTube channels won't say clearly. Silver is not a trading asset for most people watching this. It is a wealth preservation asset. And from that perspective, the question is not, will I get the perfect entry price? The question is, in 2, 3, 5 years from now, will I wish I had more silver or less silver? Given everything we've covered, the structural supply deficit, the industrial demand supercycle, the monetary anxiety across Europe and globally, the central bank behavior, the COMEX physical tightening, the answer to that question seems relatively clear. The short-term price action is noise. The long-term signal is deafening. This does not mean you should buy recklessly. It means you should be disciplined. Dollar cost average or euro cost average into a position. Physical silver from a reputable dealer gives you no counterparty risk. Silver ETFs give you liquidity. Mining stocks give you leverage to the price with additional company-specific risk. Know what you own and why you own it. That knowledge is what keeps you calm when the headline says silver plunges and the crowd panics. Let's bring this together. Silver has broken below $76 in a move driven by 3 temporary mechanical forces: Fed language, COMEX futures liquidation, and dollar strength. Underneath that paper market turbulence, the physical silver story, supply deficits, industrial demand, European monetary anxiety remains completely intact and arguably more compelling than ever. The next 48 hours are critical. Watch the $72 to $73 support zone. Watch the COT data for signs of short covering. Watch the Fed's communication carefully. The 3 scenarios are bull reversal and resumption of the 2026 run, sideways consolidation and base building, or a deeper correction towards $64 before eventual recovery. In all three scenarios, the long-term thesis for silver as a wealth protection asset holds. If this analysis gave you clarity, if it helped you think more clearly about what is actually happening, do one thing right now. Hit subscribe and turn on the notification bell. Because the next update on this situation could come within 24 hours, and you do not want to miss it. Drop the word silver in the comments if you're holding physical silver right now, or watching if you are waiting for a better entry. I read every single comment, and your input actually shapes the topics I cover next. This is not financial advice, this is analysis, and the decision is always yours. Stay sharp. I'll see you in the next one.